Welcome back, guys, to part 2 of markets and products. We're gonna open up here with our swaps material, and we are going to review the valuation of interest rate swaps and currency swaps. But let's first start with our basic net cash flow at a point in time for our interest rate swaps. So remember, with interest rate swaps, we have a payer on the left here and a receiver on the right. And the payer is the one paying the fixed rate. The receiver is the one receiving the fixed rate. So this is all in reference to the fixed rate. And then in exchange, they pay LIBOR. The receiver pays LIBOR, payer receives LIBOR. So it does look like the picture for the forward rate agreement, but of course, an interest rate swap is a series of forward rate agreements, the payer hoping, of course, that LIBOR will rise. Okay, so now in terms of the net cash flow at a point in time, so this is from the point of view of our payer or variable rate receiver. So he receives LIBOR plus potentially a spread. He pays the fixed rate, is all annualized rate, so then we have to de-annualize and multiply them by the notional principal. But the key point to notice here is that payments are made in arrears, so the payment at the end of a period is actually based on LIBOR from the beginning of the period. So there's a major mousetrap when it comes to that particular calculation. Always choose the LIBOR from the previous settlement date for this type of calculation. When it comes to the valuation of both interest rate swaps and currency swaps, we're going to use the bond methodology, which essentially means that we are going, let's say, to value the payer here by imagining that he is long a floater. Okay, why long a floater? Because he is receiving LIBOR. So to replicate the receive of LIBOR, we're just buying a floating rate note, and then we are shorting or selling a fixed coupon bond. And that replicates essentially the fixed rate payment. Now, if this was a currency swap, we would simply have two different currencies. So we could, again, treat it as, let's say, a dollar-denominated bond and a euro-denominated bond, value those two bonds with the bond methodology, and then net the two amounts to value the currency swap. I will be showing you both of these examples. But lastly, here on the slide, before we get our hands dirty with some numbers, is this theory of comparative advantage. So I'll illustrate it with this example here. I've got company X, which is a high-quality borrower. It can borrow in the fixed market at 4% or in the variable market at LIBOR plus 20. Y is a higher risk borrower, so they can borrow in the fixed market at 5.5 and in the variable market at LIBOR plus 120. So we say that X holds the absolute advantage in both markets because it can borrow more cheaply in the fixed market and also more cheaply in the floating market. However, according to the theory of comparative advantage, X can only hold comparative advantage in one of the two markets. And in this case, it holds the comparative advantage in fixed borrowing. Why? Well, because the difference in borrowing rates in the fixed market is greater than the difference in borrowing rates in the floating market. So on a relative basis, X holds a comparative advantage in the fixed market. It can borrow more cheaply in the fixed market. So therefore, X is advised to borrow fixed at 4%. So X is going to borrow, let's just clear this so we can highlight this. X will borrow fixed at 4%. That's where it holds comparative advantage. So automatically, Y must hold comparative advantage in floating markets. So Y will